Today, let's build a clear understanding of Credit Valuation Adjustment, or CVA, and Debt Valuation Adjustment, or DVA, two very important concepts in measuring credit risk in derivatives. First, let's start with the basic idea. When a bank enters into a derivative contract, like a swap, it expects future cash flows from the counterparty. However, there is always a risk that the counterparty might default before making those payments. This possibility of default creates a potential loss for the bank. This expected loss is what we call Credit Valuation Adjustment, or CVA. So, in simple terms, CVA is the present value of the expected loss due to counterparty default. Now, let's look at the opposite situation. If the bank itself defaults, it may not have to fully repay what it owes to the counterparty. From the bank's perspective, this actually creates a gain. This expected gain is called Debt Valuation Adjustment, or DVA. So, while CVA is a cost, DVA is a benefit. Let's understand this with a simple example. Suppose a bank is expected to receive 100 rupees from a counterparty in the future. If the counterparty defaults, the bank may recover only part of that amount, say 40 rupees. This means the bank loses 60 rupees. The expected value of such losses, adjusted for probability and time, is the CVA. Now consider the reverse. If the bank owes 100 rupees to the counterparty and the bank defaults, it may not repay the full amount. This creates a gain for the bank, which is captured as DVA. Because of these risks, the value of a derivative must be adjusted. The adjusted value is given by the formula F_ND equals F, CVA plus DVA. Here, F is the value assuming no default risk, and F_ND is the value after considering credit risk. So, we subtract expected losses and add expected gains. Now, let's understand how CVA and DVA are calculated. CVA is calculated as CVA equals sum of Q_I multiplied by V_I. DVA is calculated as DVA equals sum of Q_I multiplied by V_I star. Here, Q_I represents the probability that default occurs in a specific time interval. V_I represents the expected loss to the bank if the counterparty defaults during that interval. And V_I star represents the expected gain to the bank if it defaults during that interval. So essentially, we are multiplying probability of default with the exposure at that time, and then summing across all time periods. Now, an important question is, how do we calculate the default probability Q_I? It depends on the credit spread of the counterparty and the recovery rate. Here, S(T) is the credit spread, and R is the recovery rate. The intuition is simple. Higher credit spread means higher risk of default. Higher recovery rate means lower loss. In real-world applications, these calculations are not done manually. Banks use Monte Carlo simulations to simulate thousands of possible future scenarios for market variables like interest rates and exposures. This helps estimate how exposure changes over time and allows accurate calculation of CVA and DVA. Another very important concept is the relationship between exposure and default risk. This brings us to wrong-way risk and right-way risk. Wrong-way risk occurs when exposure increases at the same time as the probability of default increases. This makes losses more severe. For example, if a bank is exposed to a company whose financial condition is deteriorating, both exposure and default risk rise together. This is dangerous. On the other hand, right-way risk occurs when exposure decreases as default risk increases. For example, if collateral reduces exposure when risk rises, the overall risk is lower.